Jump in.
Okay.
Go ahead, jump in, Joe.
I'm going to let you get even with me too, Warren, but
okay.
I want to talk, and this is Andrew's, Too Big to Fail, great book, and that everybody associates that with Andrew, but my view has evolved, and you pointed that out last week, and I have real problems with Too Big to Fail, and I think that the Occupy Wall Street movement, they may not know exactly why they're upset, but the notion that you can, I was talking about it over this weekend. Let's say that you were a public employee and you went to Las Vegas with tax money, and you were allowed to put as much tax money that you want on black or red or on blackjack. And if you lost it, the taxpayers lost it and you didn't care. But if you made it, you got to keep it. That's basically what Too Big to Fail institutions are able to do, and to leave, to leave with taxpayer money, with the profits. And I see why Occupy Wall Street has a problem with that, although I'm not sure that they understand. Can we have enough regulations for these big institutions to keep them honest, Warren, or do we need to break them up?
Well, I would use this example. What happened is that some of the people you referred to went to Las Vegas, and they didn't go with taxpayer money. They went with shareholder money, and they were making a bunch of bets where heads they won and tails the shareholders lost. And if the shareholders lost all of their money, one of the reasons they could make those bets was because people felt the government would come in to back up those shareholders. But they were losing the shareholders' money. As a matter of fact, as you know, on the banks, on TARP, the government will make a profit. Now, they didn't have to turn out that way, but it did turn out that way. But the shareholders still lost tons of money. And I say the guy who goes to Las Vegas and loses the money should leave broke himself. And but I don't think it isn't that everybody got off light. The owners of the bank got killed.
But you have a vested interest in Too Big to Fail, Warren. You were able to you were able to buy Goldman Sachs, you were able to buy GE, you were able to buy Bank of America recently. So it implied you've almost got a put there with some of your purchases.
No, I'm a shareholder. The shareholders got wiped out at WAMU, Wachovia, Freddie, Fannie, almost at Citi, almost at AIG. You go up and down the line. So as a shareholder, I'm not protected. If I were the CEO, I might be protected, but not as a shareholder.
Okay, but it's not fixed yet, is it?
No, there's parts of it that are definitely not fixed, and I've written about that. I think you've got to make it so the CEO of an institution that requires society to bail out his institution, if that CEO goes away broke and his wife goes away broke.
But we still
the directors pay a big penalty
that still might not help, though. If they're that big and that's systemically important, then they're still going to get bailed out, and that's the problem, right? We need to make it so that they're not that systemically important, because they're still going to get bailed out at this point.
Well, the ones that actually, if you look at the banks, they have not cost the taxpayer anything. Now, Freddie and Fannie have cost the taxpayer plenty.
But it's still the moral hazard that's been built up. Who knows how badly that damages some of the decisions that are being made right now. Even though we got our money back.
I would say this: when we buy our B of A preferred, we do not expect the government ever to pay off our preferred. We do expect the government to pay off depositors, but we do not expect the government to pay off our preferred.
Hey, Warren, one other question, and it evolves from the financial crisis, and the Too Big to Fail issue goes back to the question about derivatives and their impact on the crisis, but also their role going forward. You've called derivatives weapons of mass destruction, and as I was looking through the earnings report from last quarter, however, Berkshire lost $2 billion in part because of derivatives. Is there a way to square that circle for you?
Well, yeah, we have entered in about 200-plus derivative contracts. I have. And I expect we will make money on those. We have the use of substantial amounts of money, and they are very, very small compared to either our assets or our earning power. We can handle any of those, any transaction we have without any discomfort whatsoever. Very few of them require any collateral, but even if they did, we would have the collateral.
So that's what I was going to ask. Do you have to post collateral for the $2 billion loss in the third quarter?
No.
Do you have to post $2 billion? No. Okay.
No.
And why is that?
We won't enter into any contract that we think could cause me to lose 5 minutes of sleep if the Dow would go down 2,000 points tomorrow.
Those contracts, though, those derivative contracts, are long-term bets that several of the major stock indexes, like the S&P 500, will go up over the course of 10, 12 years.
Or really they're bets that they won't go down a lot.
That they won't go down a lot.
Time. And we get to hold, we're holding $4.5 billion that we've had the use of now for 5 years, and we get the use of for another 10 or so years, which we get to make money with. And if we settle the contracts today at the levels of the index, they would be settled for a whole lot less than the liability that we show.
And
I'm happy with all the contracts.
The earliest contract, is it 2018?
2018. But that's not the late. I mean, they go out to 2026, I think. Do you think there's a chance that the indices could go down from where they are today because the Europe problems are still overhanging in 6 years? They can go down, but they can go up too.
Right.
Yeah, and if they stayed the same, our liability would be quite a bit less than we show on our balance sheet.
Okay. Why don't we talk a little bit more about some of the earnings? You mentioned already the strength of some of those businesses that you've seen and how strong the American economy is as a result. You also spent a lot of time in the last quarter buying equities, $7 billion.
You noticed?
Yeah, we did notice. A lot of people have been paying attention to this. You've got to file with the SEC tonight, to say what you were buying in the last quarter. Can you tell us now what you were buying?
Yeah, but I would like to make it interesting. And Joe and Andrew and you are always torturing me with these quizzes that you give. You know, you send Scott Cohn out someplace and have him issue some enigmatic word or something, and I'm supposed to figure out where he is and all that. So I would like, you mentioned movies. If you remember in The Graduate, when Mr. McGuire called Benjamin at the party very early, and he said, now just one
Plastics?
word. Plastics. Yeah. Put his arm around him, plastics. So I'm going to say one word, and I want you to figure out where we put all that money. And the word is Herald.
Warren Buffett addresses concerns about the too-big-to-fail phenomenon, emphasizing the need for accountability and prudent regulations. He suggests that CEOs of bailed-out institutions should face significant personal financial penalties to discourage reckless behavior. Additionally, Buffett shares his cautious approach to derivatives, ensuring they never pose a risk to Berkshire Hathaway's financial stability. His long-term strategy focuses on leveraging opportunities while maintaining a conservative risk profile.